Before we begin, disclaimer. Nothing in this video constitutes financial advice. I am not a financial advisor. Past performance does not guarantee future results. All data presented is for educational purposes only. Always consult a qualified professional before making investment decisions. Now, with that out of the way, what if the single most common piece of investing advice repeated by every major brokerage, every financial advisor, every best-selling personal finance book is wrong 60% of the time? Not slightly wrong, not a little off. Wrong more often than it's right. That's what the data shows about portfolio rebalancing. And today we're going to walk through every piece of evidence, the theory, the numbers, the hidden costs, so you can decide for yourself. If you've ever read a personal finance book, talked to a financial advisor, or visited any major brokerage website, you've heard this advice: rebalance your portfolio. Vanguard says it, Fidelity says it, Schwab says it. Every robo-advisor does it automatically. The claim is always the same. Rebalancing adds somewhere between 0.5% and 1% per year to your returns. Some call it the only free lunch in investing, a phrase often attributed to Harry Markowitz. And it sounds right, doesn't it? Sell what's gone up, buy what's gone down, stay disciplined, stay mechanical. But here's the thing, when you actually look at the data across nearly a century of market history, the picture gets a lot more complicated. Let's start with why the idea is so appealing in the first place. Imagine two buckets. One holds your stocks, the other holds your bonds. You start with 60% in stocks and 40% in bonds. Over time, stocks grow faster. Now you're at 75% stocks and 25% bonds. You're taking more risk than you intended. Rebalancing says, pour some from the stock bucket back into the bond bucket. You're mechanically selling high and buying low. No emotion, no market timing, just math. It's elegant. It's disciplined. It removes the hardest part of investing, your own psychology. So why doesn't the math work the way everyone says it does? To understand that, we need to go back to 1948. Claude Shannon, the father of information theory, proposed a thought experiment. Take two assets that go up and down in perfect opposition. Neither one actually goes anywhere over time. Each starts at $100 and ends at $100. The geometric return of holding either one is zero. But here's the magic. If you split your money 50-50 between them and rebalance periodically, you end up with $122. You generated a positive return from assets that individually went nowhere. Shannon's insight was profound. Volatility combined with rebalancing can create return out of pure noise. You're buying low and selling high not because you're smart, but because the math forces you to. Every time one asset falls, you buy more of it. Every time it rises, you trim. The rebalancing itself generates the return. This is the theoretical foundation for the entire rebalancing argument. And the theory is genuinely brilliant. It's one of the most elegant ideas in all of quantitative finance. Here's why it works mathematically. Your geometric return, what you actually earn, is roughly equal to your arithmetic return minus half the variance. That's the volatility drag. If a stock earns 10% on average but swings wildly, the drag might be 2%, leaving you with 8% geometrically. The more volatile the asset, the bigger the gap between what you earn on average and what you actually get. Rebalancing reduces portfolio volatility by keeping your allocation stable. Lower volatility means less drag. Less drag means a higher geometric return. The math is ironclad. Shannon proved it, so what went wrong? Shannon's demon works under three specific conditions, and all three need to be true simultaneously. First, the assets must be uncorrelated, a correlation below 0.3. When one zigs, the other zags. That's what creates the oscillation you can harvest. Second, they need similar expected returns. If one asset grows at 10% and the other at 2%, the portfolio drifts permanently toward the winner. Rebalancing just fights the trend. Third, prices must mean revert, go up, come back down, go up again. Without mean reversion, you're just selling winners into a trend. When all three conditions are met, rebalancing produces a genuine bonus. The problem is that real-world markets rarely satisfy all three at once. Stocks and bonds have shifted between positive and negative correlation repeatedly over the past century. Expected returns are wildly different, and markets trend, sometimes for decades. Now let's see how reality compares to the theory. Here's a 60-40 stock-bond portfolio from 1987 to 2024. 3 versions. Monthly rebalancing, 8.84% annualized. Annual rebalancing, 8.91%. Never rebalanced, 9.65%. Read that again. The portfolio that was never touched earned more, about 0.75% per year. On a $100,000 initial investment, that gap compounds to roughly $700,000 over the full period. The catch? The non-rebalanced portfolio drifted to about 85% stocks. It took on significantly more risk. You earn more because you took more risk, not because buy and hold was smarter. When you adjust for the risk taken, the rebalancing bonus disappears entirely. Same risk, same return. That's the first clue that something is off with the standard narrative. But that single window is cherry-picked. Let's look at every rolling 20-year period going back to 1926. This is the most revealing picture in the entire analysis. In each 20-year window, we ask, did rebalancing add or subtract compared to not rebalancing? Green means rebalancing won. Red means it lost. The pattern is stark. Rebalancing wins in periods that start near major crashes, 1932, 1974, 2002, 2009. In those windows, the rebalanced portfolio bought stocks at deeply discounted prices and rode the recovery. It loses in periods that start during bull markets, the 1950s, the 1980s, the 1990s, the 2010s. In those windows, every rebalance trimmed a winning position that kept winning. Overall, rebalancing wins about 40% of 20-year periods and loses about 60%. If you started investing during a bull market, rebalancing cost you money. Every single time. That's not a free lunch. That's a coin weighted against you. Maybe you're thinking, what if I rebalance more often? Daily, weekly, monthly? Let's test 6 different frequencies: daily, weekly, monthly, quarterly, annual, and never. The returns are nearly identical, all within a few basis points of each other. The only thing that changes dramatically is turnover. Daily rebalancing generates over 300% annual turnover. Annual, 4%. As Michael Kitzes has written, there is no meaningful improvement in long-term risk or returns from more frequent rebalancing. And after accounting for transaction costs and taxes, frequent rebalancing is actually worse. The frequency doesn't fix the fundamental problem. All right, but what about adding more asset classes? If 2 assets aren't enough, surely 5 or 7 will diversify the bonus into existence. Let's build it up. 3 assets, U.S. stocks, international stocks, bonds. 5 assets, add rate and commodities. 7, add small cap value and tips. More assets do create slightly more opportunity for rebalancing gains. Each pair of uncorrelated assets is a small potential bonus. But here's the problem. Correlations have been rising for decades. Globalization, central bank coordination, and interconnected markets mean that what used to be uncorrelated assets now tend to move together, especially during crises, exactly when you need diversification most. You can't diversify away the correlation problem. More assets just means more complexity, more transaction costs, and more opportunities for things to move in the same direction when you need them not to. The rebalancing bonus doesn't scale with portfolio complexity. If anything, it gets harder to capture. Shannon's demon works because assets bounce around a mean. They go up, they come back down, they go up again. In a mean-reverting market, rebalancing is harvesting that oscillation, but real markets trend. From 1982 to 2000, stocks went up almost continuously. From 2009 to 2021, same thing. In a trending market, every rebalancing trade sells the winner and buys the loser. You're systematically cutting your profits and adding to your losses. Rebalancing is a bet on mean reversion. In a trend, you bleed slowly. And since markets trend more often than they mean revert, especially in equities, which have an upward bias by design, the bonus is negative more often than it's positive. You're fighting the current most of the time. The occasional win during a crash doesn't always make up for the steady drag during the long stretches between crashes. The entire rebalancing bonus depends on correlation. When stocks and bonds move in opposite directions, rebalancing captures the zigzag. When they move together, there's nothing to capture. From 1970 to 1999, the stock-bond correlation was positive, about 0.35. Rebalancing was a drag. From 2000 to 2023, correlation turned negative, about minus 0.29. Rebalancing looked like a genius. The lost decade from 2000 to 2010 was the golden age of rebalancing. Stocks crashed, bonds rallied. Every rebalance bought stocks near the bottom. But the bull decades, 1982 to 2000 and 2010 to 2024, were the opposite. Stocks kept winning, bonds underperformed, and every rebalance cost you. The rebalancing bonus is entirely correlation dependent, and correlation is not a constant. It changes, sometimes for decades at a stretch, which brings us to where we are today. In 2022, the 60-40 portfolio had its worst year in decades. Stocks fell, and bonds fell with them. Correlation flipped positive. A traditional rebalancing strategy offered no protection because there was nowhere to hide. Heading into 2026, stock-bond correlation has remained elevated. The negative correlation regime that made rebalancing look brilliant from 2000 to 2020 may be over. If that's the case, rebalancing is likely costing you money right now, just as it did through most of the 1970s, 1980s, and 1990s. The regime matters, and you don't know which regime you're in until you're already through it. Now let's talk about where rebalancing actually works, because it does work sometimes and those times matter. The dot-com crash. From March 2000 to October 2002, the S&P 500 fell 47% over 2.5 years. Stocks plunged. Bonds rallied. If you were rebalancing quarterly, each quarter you sold some bonds and bought stocks, getting them cheaper each time. When the recovery came, the rebalanced portfolio had accumulated more stock shares at lower prices. Over the next 5 years, it outperformed by about 1 to 1.5% annually. Deep, slow crashes are where rebalancing earns its reputation. Same story, different crash. The global financial crisis. October 2007 to March 2009, the S&P 500 fell 57%. Bonds held up. A quarterly rebalancer sold bonds and bought stocks through the entire decline. By 2011, the rebalanced portfolio had pulled ahead by roughly 0.8% per year. It's a meaningful edge, but only if you actually executed every single quarter, including the ones where it felt terrifying to buy more stocks. This is the catch. Rebalancing works during crashes precisely because it's doing the thing that feels the worst. And then there's 2020. The S&P 500 fell 34% in 23 trading days, the fastest bear market in history, and then it recovered almost as quickly. The entire crash and recovery played out in less time than most quarterly rebalancing schedules could react to. If your quarterly rebalance date was March 31st, the market had already recovered half its losses. By June 30th, you were near all-time highs. The crash was too fast for a quarterly rebalancer to capture any benefit. Even monthly rebalancers only caught a fraction. For annual rebalancers, the bonus was essentially zero. The market gave back everything and took it all before your calendar date arrived. Fast crashes are the market's way of telling you that mechanical rules can't keep up. And as markets become more algorithmic and faster moving, these snapback recoveries may become more common, not less. Even when rebalancing produces a theoretical bonus, taxes eat it alive in taxable accounts. Let's walk through a specific example. You have a $100,000 60-40 portfolio. Stocks have done well, your allocation is now 65-35. To rebalance, you need to sell about $5,000 of stocks. If those shares were held less than a year, that's a short-term capital gain, taxed as ordinary income, up to 37% federal. If held longer, it's long-term, 15 to 20%. Then add state taxes, which range from 0 to over 13% depending on where you live. That single rebalancing event might cost you $1,000 to $1,500 in taxes. Now multiply that by every year for 30 years. The annual tax drag is 0.3 to 0.8%. Over 3 decades, the compounding difference in after-tax wealth can easily reach $100,000 on a single $100,000 investment. The rebalancing bonus, even in the best case, often gets eaten entirely by taxes in taxable accounts. Beyond taxes, there are transaction costs. Bid-ask spreads on liquid ETFs are small, a basis point or two, but they exist on both sides of every trade. For small accounts, minimum commissions can be meaningful relative to the trade size. For large accounts, market impact becomes a factor. Your own trades move the price against you, especially in less liquid bond markets or during periods of market stress. Individually, these costs are minor, but compounded annually over decades, they're a persistent drag that further erodes whatever theoretical bonus rebalancing might offer. Every friction costs money. And in investing, frictions compound. What looks like a rounding error in year 1 becomes a meaningful sum by year 30. Here's the cost nobody talks about, the psychological one. Rebalancing into a falling market feels terrible. You're buying something that just lost 20, 30, 50%. Every instinct screams at you to stop. According to Dalbar's quantitative analysis of investor behavior, the vast majority of investors fail to rebalance during market crashes, exactly when it adds the most value. And in trending markets, rebalancing is disciplined and mechanical, but it's costing you money. So investors execute it dutifully during the bad times and dutifully during the good times. The people who skip rebalancing during crashes miss the only period where it adds value. The people who rebalance through bull markets pay the penalty. The behavioral case for rebalancing, that it removes emotion, is its strongest theoretical argument. But it's also its weakest execution. Because when the moment comes to actually do it, most people don't. Let's compare 4 rebalancing approaches. First, never rebalance, highest return, highest volatility, maximum drift. Second, annual calendar, the default recommendation. Third, 5% threshold bands, only rebalance when your allocation drifts more than 5 percentage points. Fourth, 20% threshold, only act on very large moves. The data shows that threshold rebalancing captures most of the crash recovery benefit with far less turnover than calendar rebalancing. The 5% threshold band triggers during major dislocations, like 2008, like 2020, but stays quiet during normal market fluctuations. Meanwhile, annual calendar rebalancing trades every single year regardless of whether anything meaningful has happened. Most years, it's just generating costs for no benefit. The best method isn't calendar rebalancing. It's threshold rebalancing. You rebalance only when the market has moved enough to make it meaningful, and you leave it alone the rest of the time. Think of it as a fire alarm. You don't test it every day. You wait for smoke. So here's the practical framework. 3 rules that minimize costs while capturing whatever benefit exists. Rule 1. Rebalance in tax-deferred accounts, your IRA, your 401k. There's no tax cost for selling inside these accounts, so you eliminate the biggest drag entirely. Rule 2. Use new contributions in taxable accounts. Instead of selling winners and triggering gains, direct new money into the underweight asset. It's slower, but it's tax efficient. Rule 3. Set a 5% threshold band. Don't rebalance on a calendar. Rebalance when your allocation drifts more than 5 percentage points from target. This captures the crash recovery benefit while minimizing unnecessary trades. This is the framework that keeps costs near zero while preserving most of the risk management value. What about target date funds? They rebalance automatically, usually daily. They are the hands-off solution, and they genuinely solve the behavioral problem. You never have to make a decision, but they create a tax problem. Target date funds hold bonds internally, which means interest income flows through to you even in taxable accounts, taxed at your ordinary income rate. They also shift your allocation on a predetermined schedule, becoming more conservative as you age, regardless of market conditions or your actual financial situation. In a tax-deferred account, target date funds are a perfectly reasonable choice. In a taxable account, they are tax inefficient and inflexible. Target date funds solve the rebalancing problem at the cost of tax optimization. So here's the honest verdict. Rebalancing is not a return enhancement. The statistical bonus across all periods, all frequencies, and all asset mixes is about 8 basis points per year. Effectively 0, and that's before taxes and costs, which push it negative in most real-world situations. Rebalancing is risk management. It reduces portfolio volatility by 15 to 20%. That's real. That's valuable. If your goal is to keep your portfolio aligned with your actual risk tolerance, to prevent yourself from accidentally becoming 90% stocks during a bull market, rebalancing does that job reliably. The distinction matters enormously. If you're rebalancing because you think it'll boost your returns, the data says you're wrong most of the time. If you're rebalancing because you want to control risk, the data fully supports you. But don't confuse the two. Risk management and return enhancement are different goals, and conflating them leads to bad decisions. Rebalancing is risk management, not return enhancement. Treat it accordingly. To summarize, the rebalancing bonus is real in theory, intermittent in practice, and often negative after costs. The conditions that make it work, uncorrelated assets, mean-reverting prices, are not guaranteed and shift over time. The hidden costs, taxes, transaction friction, and behavioral failure frequently exceed the benefit. If you rebalance, do it in tax-advantaged accounts where there's no tax penalty. Use threshold bands, not calendar dates, so you only act when it matters. And understand that you're managing risk, not chasing returns. That honest framing will serve you far better than the myth of the free lunch, and one